Welcome back. You're watching Midcap Bazaar. Another company that's in focus today is Reliance Media. Take a look at how the count is doing. It's down about 3%. The last time I did a check on that stock, and still looking extremely weak in terms of stock performance. We've got with us Anil Arjun, CEO of Reliance Media, joining us to talk about what's going on with the company. Thanks, Anil, for joining us this afternoon on Bloomberg UTV. Anil, to get started, take us through how the second quarter has been, the key financial highlights of the quarter.
Yeah, it's been a good quarter for us. On a trailing quarter basis, we grew revenues by nearly 21%. We're nearly about 240 crores in terms of top line, which is a good number in terms of traction for us on a trailing quarter basis. From an operating performance perspective, we've actually reached operating break-even, and this despite incurring nearly about 10 crores in terms of startup costs for stabilizing various new business in visual effects and 3D conversion. So it's been a good quarter. From the segment-wise breakup, nearly 60% of the business has come from exhibition. The balance of it has come from film and media services and television production.
Anil, of course, that's the business outlook, right? But talk about how the quarter is looking. What is the sort of expectations you have going ahead? I know this is typically not a peak season for the cinema business. So what is the sort of traction you're expecting on that front? And also your international business, any sort of pickups on that front?
Not really. If you look at our businesses, in fact, the season time is on for the cinema business. So our exhibition business should see some traction in terms of Q2, Q3, Q4 in terms of season time as a business. Our film and media services space, which has been a major area of thrust for us in terms of investment over the last 2 years, has seen nearly 300 crores in terms of capital expenditure in terms of building out studios, visual effects facility, 3D conversion facility, investment in manpower and training. That has seen a lot of traction in terms of order book position. We already started a fair amount of work on a lot of international projects, and over the next 2 to 3 quarters, we see substantial scale up in their activity in terms of business. So I'm seeing 3 very positive quarters in terms of the revenue growth and earnings for us.
All right, there has been some talk about some restructuring in the business and how you're going to move some of those subsidiaries around. Can you share some details with us?
If you look at our business as a company in the last 5 years, in 2005, we had a film processing laboratory and 24 screens in terms of multiplex screens. The total asset base of the company was roughly about 150 crores. We had a top line of roughly about 140 crores. What's happened over the last 5 years has been that over a period in terms of revenue growth is moved from roughly about 140 crores to nearly about 1,000 crores in terms of annualized revenues every year. Our asset block has increased from 150 crores to almost about a gross block of 1,800 crores over the last 5 years. What has really happened with this growth is that our investments from the entire business has moved to really about the entire spectrum. So if you see, for example, the domestic film and media services space, we moved from just being a laboratory to the entire backward and forward integration into studios, cameras, rental, post-production, visual effects, CGI, animation, subtitling, digital mastering, and the entire space related to broadcast services as well as television post-production services and as well as ad commercial services. Similarly, we built large outsourcing centers for BPO work, which involves visual effects and imaging services as the BPO back in India, with front-end centers out of London and USA. In the exhibition space, from 24 screens, we moved to nearly about 550 screens across India, US, Malaysia, and Nepal and Netherlands. All this really meant that as a company, we were fairly large in terms of capital expenditure, organized with several divisions. So what we have done really as part of the whole process is at the board has taken an in-principle decision to be able to organize these businesses into structured as subsidiaries of the main company to provide greater focus, to provide greater strength to each of the business individual business segments, so that by and large all these 14-15 businesses of ours, which are individually entities, would come into simple neat structures of exhibition, film and media services, and television production. That's been the strategic initiative which has been taken, and the board has taken an in-principle decision today. This has to be effectively, run out through all what we call the tax, regulatory, and other aspects of the as part of the whole process, which should be done shortly. But that's been the process which has been decided this today.
All right, Anil, thanks for joining us right here on Bloomberg UTV and sharing those details. We'll take a short break. On the other side, we put the focus on Mahindra Satyam. That stock up after a strong set of earnings and strong commentary from the management. We'll tell you what's going on in that counter.